In early 2024, a lawsuit landed quietly on the desks of Oracle's legal team. It wasn't a disgruntled employee, it wasn't a copyright dispute, it was a securities fraud allegation, claiming Oracle's executives had misled investors about the true state of their AI business. The stock had already cratered nearly 14% in a single session after one earnings call. $40 billion in market cap gone overnight. But here's what almost nobody reported. That drop wasn't an accident. It wasn't a surprise to everyone in the room. It was the moment the bluff cracked. And if you have money in the markets or you work in tech, what happens next matters far more than you think. The setup: public narrative versus hidden truth. Let's rewind. Because to understand where Oracle is now, you need to understand the story they've been selling. The public narrative goes something like this. Oracle is a comeback story. A 40-year-old database giant that somehow outmaneuvered the cloud era, bet big on AI infrastructure, and landed contracts with the most powerful companies on the planet, including deals tied to the U.S. government's Stargate initiative, worth potentially hundreds of billions. Larry Ellison, the founder, the third richest man on Earth at points, is back on the winning side of history. That's the headline. That's what the press releases say. But here's what the balance sheet says. Oracle is currently carrying roughly $90 to $100 billion in long-term debt. That's not a rounding error. That's more debt than the entire GDP of many mid-sized countries. So the question you have to ask is this: is Oracle genuinely becoming an AI powerhouse, or is it spending like one to distract from a financial structure that's quietly becoming unsustainable? Oracle's interest expense alone in fiscal year 2024, over $3.5 billion. That's $3.5 billion a year just to service the cost of borrowing before they build a single data center, hire a single engineer, or train a single model. This is the hidden truth the earnings calls don't open with. And it gets worse. The debt structure. Let's talk about how Oracle built this debt mountain, because it didn't happen by accident. Between 2016 and 2023, Oracle spent over $70 billion buying back its own stock. $70 billion. Borrowed money, used to inflate share prices, make executives' equity packages look better, and signal confidence to Wall Street. It's a legal strategy. Lots of companies do it, but Oracle did it aggressively at a time when it was losing the cloud war to Amazon, Microsoft, and Google. While AWS was becoming the default backbone of the internet, Oracle was handing cash back to shareholders instead of investing in infrastructure. By the time they woke up to the cloud transition and decided they needed to build out massive GPU clusters to compete in the AI era, they had to do it on a foundation of debt. So now Oracle is in a bind that very few analysts are talking about plainly. To compete in AI infrastructure, they need to spend tens of billions more on data centers and chips. But to fund that spending, they have to either take on more debt, which is getting more expensive in a high interest rate environment, or convince investors that the AI revenue is already here. Which brings us to evidence number 2, the AI bluff. Here's where it gets genuinely interesting. Oracle's cloud infrastructure business, what they call OCI, Oracle Cloud Infrastructure, has been growing. Real growth. The company reported multi-billion-dollar remaining performance obligations, essentially future contracted revenue, and those numbers were impressive. But investors and analysts started asking harder questions. When does that revenue actually hit the income statement? How much of it is real signed commitments versus letters of intent? And how much of the AI workload narrative is driven by actual repeatable enterprise customers versus a handful of massive, one-time, government-adjacent deals? The securities lawsuit alleged that Oracle's leadership had painted an overly optimistic picture of demand, specifically around AI cloud capacity, without fully disclosing the risks, including the possibility that big customers were already shifting toward building their own infrastructure or choosing competitors. And here's the rhetorical question you need to sit with. If Oracle's AI business were truly as strong as the investor presentation suggested, why did a single earnings call with numbers that missed expectations by a thin margin cause a $40 billion wipeout in a single day? Markets don't punish slight misses that brutally unless investors feel they were sold a different story. Legal pressure builds. The securities lawsuit is just the most visible pressure point. Oracle has also faced regulatory scrutiny around data privacy, particularly following its $115 million settlement over the sale of personal data without consent. There are ongoing questions in Europe, and the company's aggressive lobbying around government AI contracts raises its own set of ethical and legal questions that are only beginning to surface. The legal picture isn't a single threat. It's accumulated. And when you combine debt pressure with investor skepticism, with legal exposure, you don't need a single catastrophic event to sink a company. Sometimes it's a slow bleed, the ticking time bomb. Let's talk about what actually happens if this bluff fails, because that's the question nobody's asking loudly enough. Oracle's plan hinges on one thing, that AI infrastructure demand keeps growing fast enough to justify the spending, service the debt, and deliver the margins Wall Street needs to keep the stock elevated. But there are three scenarios where that plan falls apart. Scenario 1, the AI capex bubble. The AI infrastructure boom is being driven by a small number of hyperscalers, Microsoft, Google, Amazon, Meta. If any of those companies decide to build more in-house, or if AI demand growth decelerates even slightly, the pipeline of contracts Oracle is counting on could dry up faster than their debt payments. Scenario 2, the rate trap. Oracle refinances debt in a world where interest rates stay elevated. Their interest burden climbs, margins compress. They face a hard choice: cut investment in the very AI infrastructure that's supposed to be their future, or keep borrowing and hope the revenue shows up in time. Scenario 3, the lawsuit catalyst. Securities fraud. Lawsuits rarely kill companies on their own, but they do something dangerous. They destroy institutional confidence. If large funds start quietly trimming Oracle positions, worried about legal liability, worried about disclosure risk, the stock slides. And a sliding stock makes the debt picture look worse. It's a feedback loop. Here's the number that ties it all together. Oracle's debt-to-equity ratio sits in deeply negative territory, meaning their liabilities exceed the book value of their assets. That is not a healthy company hiding behind strong earnings. That is a company in a financial structure that requires continuous, perfect execution just to stay standing. One bad quarter, one lost contract, one rate shock, and the margin for error disappears. What does that mean for you? If you're an investor holding Oracle stock as an AI infrastructure play, you're not just betting on the technology. You're betting that Larry Ellison can thread a needle between mounting debt, legal exposure, and a hyper-competitive market while making it look effortless. That's a very different bet than the one the press releases describe. And if Oracle wobbles, given the interconnected nature of the cloud and AI supply chain, the ripple effects touch every company that's embedded OCI into their stack. Enterprise transitions are expensive, painful, slow. The secret reality. So here is the secret reality, the version of this story that doesn't make it into the Investor Day presentations. Oracle is not a company comfortably building the future of AI. Oracle is a company racing to make the AI narrative stick before the financial math catches up. The $100 billion debt isn't a side note. It's the context for every AI announcement, every data center expansion, every government partnership Larry Ellison announces with a smile. Each of those announcements is also functionally a message to bond markets and shareholders. We're fine. Don't look at the balance sheet, look at the future. That's not unique to Oracle. It's how a lot of late cycle corporate pivots work. But Oracle is doing it at massive scale in one of the most capital intensive and competitive industries in human history, while carrying a debt load that would make a private equity firm nervous. And here's the part that should genuinely unsettle you. The AI infrastructure race isn't slowing down. It's accelerating. NVIDIA GPUs are still back-ordered. Data center construction timelines stretch years. The capital requirements to stay competitive aren't getting smaller. They're compounded, which means Oracle can't simply pause the spending and stabilize the balance sheet. Pulling back now would signal weakness to exactly the institutional investors they need to keep confident. So they're locked in, spending more to justify the spending that came before. It's a treadmill, and the speed keeps increasing. There's also a human cost to this that rarely gets discussed. When companies in this position start to feel the pressure, really feel it, the cuts don't start at the top. They start with headcount, with vendor contracts, with the quieter parts of the business that don't make the earnings call highlights. Oracle has already gone through significant layoff cycles in recent years. Thousands of employees, people who built careers inside a company that was simultaneously telling the market it was thriving. That gap between the internal reality and the external narrative is where the real damage lives. And let's be honest about the broader implication here. Oracle is not the only company doing this. It is one of the most visible examples of a pattern running through the entire AI investment cycle right now, where the story of AI transformation is being used to paper over structural weaknesses that existed long before ChatGPT became a household name. The difference is that Oracle's debt load makes the stakes uniquely high. There's less cushion, less room for the story to take longer than expected to become real. And the lawsuit sitting in federal court right now asks a simple, devastating question. Did Oracle's executives know the gap between the story they were selling and the reality they were managing, and choose to keep talking anyway? We don't have a verdict yet, but markets have a way of delivering their own verdict before the courts do. So here's what I want to know from you. The securities lawsuit against Oracle alleges executives misled investors about the strength of their AI business while sitting on nearly $100 billion in debt. Do you think that's aggressive accounting or something that crosses a line? Drop your take in the comments. Because the more people who understand what's actually happening inside these AI revolution balance sheets, the harder it becomes to keep the bluff going. And if this is the kind of story the financial press isn't telling you, hit subscribe. Because there are a lot more balance sheets that look exactly like this one.